When Ray Dalio raises the alarm about a potential crisis, it's wise to sit up and take notice. And right now, he's sounding the horns louder than ever, warning of an impending American mortgage meltdown that could shake the very foundations of the housing market. For many Americans, homeownership is the epitome of the American dream, a symbol of stability, security, and success. But according to Dalio, the American dream could be turning into a nightmare faster than you can say subprime mortgage crisis. So what exactly is causing Dalio's alarm bells to ring? Well, it all comes down to a toxic cocktail of rising interest rates, inflated housing prices, and a surge in risky mortgage lending. As interest rates climb higher, homeowners are finding themselves stretched thin, struggling to keep up with their mortgage payments. Meanwhile, sky-high housing prices have pushed many would-be buyers to take on ever larger loans, often with little regard for their ability to repay. Mortgage rates hit a 21-year high this week, a milestone that makes home buying a much more expensive prospect for those interested. A mortgage rate is the interest rate charged for a home loan, and effectively the monthly cost of borrowing that money. As mortgage rates have gone up, monthly payments have become more and more expensive for people looking to purchase a home, even if the base price of the house stays the same. For example, under a 3.22% 30-year fixed mortgage rate in January 2022, the monthly payment of a $400,000 house in New York with a 20% down payment was $1,716 per a bank rate calculator. Under a 7.09% mortgage rate in August 2023, the monthly payment on the same house with the same price would be $2,477. Such costs have impacted the housing market. As mortgage rates have increased, some potential buyers have held off purchasing houses. At the same time, sellers have similarly been less likely to list their property. Current homeowners have a significant incentive to wait until rates go down before deciding to re-enter the market and search for their next house. So why is this all happening? One of the most significant factors in the rise in mortgage rates is the Fed's approach to monetary policy, which includes interest rate hikes to combat inflation. Typically, mortgage rates track the yield on the 10-year Treasury note and don't directly reflect interest rate increases. An uptick in the interest rate, however, can affect Treasury yields. Since March 2022, the Fed has raised interest rates 11 times, going from a 0.0 to 0.25% range to a 5.25 to 5.5% range. These hikes can indirectly affect higher long-term mortgage rates because they make it pricier for banks to borrow money, and those institutions shift those costs onto consumers by raising rates on loans, such as those for cars and mortgages. In an apparent trade-off for the pain many consumers may feel regarding higher loan payments, the Fed's efforts have helped lower inflation. Some experts now predict that the U.S. has higher chances of a soft landing or a state of low inflation that also avoids a recession, versus the more aggressive economic downturn many had once feared. A July CPI report found that inflation was at the lowest levels in months, at 3% year over year, compared to a 9.1% level last June. Economic growth indicators such as gross domestic product (GDP) and the employment rate influence mortgage rates. With economic growth comes higher wages and greater consumer spending, including consumers seeking mortgage loans for home purchases. That's good for a country's economy, but the upswing in the overall demand for mortgages tend to propel mortgage rates higher. The reason behind this is that lenders only have so much capital to lend. The opposite is true when the economy starts to slow down. Employment and wages decline, leading to decreased demand for home loans, which puts downward pressure on the interest rates offered by mortgage lenders. Trends and conditions in the housing market also affect mortgage rates. When fewer homes are being built or offered for resale, the decline in home purchasing leads to a decline in the demand for mortgages and pushes interest rates downward. Higher mortgage rates have made monthly payments on a house much pricier, even while a home's base price may have stayed the same over the last year and a half. That has deterred some prospective home buyers from purchasing for the time being. Per an April U.S. News & World Report survey, 66% of people interested in buying say they're waiting until rates go down before they do so. Economists predict that mortgage rates will remain elevated for at least a few more months, and even when they start to come down, they are expected to settle well above the rates that home buyers enjoyed during the early stages of the pandemic. Thanks to the average mortgage rates remaining at more than double what they were in 2020 and 2021, and home prices staying sky high, housing activities remain stagnant. Existing home sales are at their lowest levels since the height of the foreclosure crisis in 2010, and mortgage demand has dropped to lows not seen in over 2 decades. At the same time, we continue to live in an economically uncertain period. Household debt, led by mortgages, credit cards, and student loans, recently surpassed $17 trillion. On top of that, inflation remains above the Federal Reserve 2% target rate, and a recession is still possible in 2024. This begs the question, could the housing market be on the verge of a crash? For years, low mortgage rates have been the saving grace for countless Americans looking to secure their slice of the real estate pie. These historically low rates have fueled a buying frenzy, driving demand to unprecedented levels and pushing home prices skyward. But as the saying goes, what goes down must eventually come up. And now the long-anticipated rise in mortgage rates is sending shockwaves through the housing market. For homeowners already struggling to make ends meet, the increase in mortgage rates is nothing short of a financial earthquake. Suddenly, the dream of homeownership is overshadowed by the looming specter of foreclosure. As monthly mortgage payments soar to unmanageable heights, families are forced to tighten their belts, cut back on expenses, and make difficult decisions about their financial future. Demand typically spikes when rates cool. If rates cool enough to create a surge in demand, the limited housing inventory could cause prices to shoot back up, making homes unaffordable for more would-be homeowners, especially first-time buyers. For some shoppers looking to buy a home now, this means moving away from big cities to more affordable metros. For others, it could mean stretching their budgets or compromising on house size or other amenities. So, what can be done to avert this looming crisis? According to Dalio, the time is to act now. From tighter lending standards to government intervention and increased oversight, bold measures are needed to prevent history from repeating itself. But whether the powers that will be heed Dalio's warnings remain to be seen. Make sure to let us know your thoughts and don't forget to like today's video. We'll see you on the next video. Thanks for watching.